Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for their third quarter of fiscal year 2023, and that stock is Microsoft. And we can see over the last year, this stock is completely outperforming the market. They're up 20%, while the rest of the market is up only 3%. So they are doing really well at the moment. And so in this video, I'm going to look into some of the recent news that came out surrounding why Microsoft might be a really good investment at the current moment. And I'm also going to look into their financial statements to look at some of their revenue and earnings growth. And then I'm going to figure out what their company is worth from an intrinsic value standpoint by using a discounted cash flow model. And so right here in this article, we can see it's titled 2 Good Reasons to Buy Microsoft Stock Right Now. And they point out some key points here that roughly 90% of global technology spending has not yet migrated to the cloud. And obviously the cloud sector, in this case, Microsoft Azure, is one of Microsoft's fastest growing business sections or parts of their business. And so if a lot of the world hasn't migrated to the cloud yet, and that's definitely a really big opportunity for Microsoft. And then on top of that, artificial intelligence and Microsoft's investments into ChatGPT and integrating that into their search engine could send their profits sharply up higher. So if I scroll down here, some of the points that I highlighted are first right here, that their Azure and other cloud service products jumped 27% in revenue in the fiscal third quarter and 31% when you're adjusting for foreign currency fluctuations. They talk about how one of their main competitors, Amazon, and their cloud services are both poised to capitalize on the fact that 90% of global IT spending has yet to migrate to the cloud. But Azure is actually growing even faster than AWS, Amazon Web Services, and so Microsoft could be positioned to benefit on this trend even more than their main rival here. On top of that, artificial intelligence and Microsoft's expansion to quickly integrate ChatGPT into their products, mainly their search engine Bing, could give them a competitive advantage over Google, the incumbent dominant search engine. In particular, they point out that they've been integrating AI into their Microsoft products like Microsoft Word and Excel, team communications, as well as their code writing tools. And they're trying to do this in order to make these tools more valuable to their users and increase functionality, which in the future might make it possible for them to charge higher prices for their software, which would obviously increase their revenues and their profit margins. And their profit margins are already pretty high. I've been talking about it a lot in all of the recent videos I've been making. Whenever we look at profit margins for companies we've been looking at, Microsoft has the highest net profit margin out of any company that we've looked at. And this investment that they're making into their products could send their profit margins even higher. On top of that, right here, they point out that there's an increasing amount of global internet search advertising revenue to be had. It's projected to be around $400 billion by 2026, and Microsoft is poised to increase their share of that global revenue. You can see from this chart right here, they point out that at the moment, the global search advertising revenue comes out to be a little under $300 billion, but by 2026, that could increase to $400 billion. And so Microsoft is obviously trying their best to capitalize on that opportunity. CEO Satya Nadella is using AI to try to wrestle users away from Alphabet's Google. They've been deploying ChatGPT with Bing in order to deliver more relevant and complete answers in a convenient and conversational way whenever users use their search engine. And then also some other big companies in the world like Samsung and Apple are also thinking about switching their default search engine from Google to Bing. And if they're able to do that, then that would obviously also increase a lot of the traffic that is coming to Microsoft's search engine Bing instead of to Alphabet's search engine Google. So a lot of interesting stuff coming up in the future. If Microsoft is able to capitalize on this AI opportunity, then that could give them a massive competitive edge over Google and turn them into the dominant search engine, which would definitely be great news for Microsoft and not very good news for one of their main competitors, Google. And so right here, we can see in this income statement, they're looking at their results for the first quarter or for the third quarter of fiscal year 2023 and the third quarter of fiscal year 2022. Total revenue during that period is up from $49 billion to $52.8 billion. That's an increase of around 7% year over year. As the article pointed out, cloud revenue is up around 27% year over year, so that's some pretty insane growth for their cloud sector. Also right here in net income, their net income also increased from $16.7 billion to $18.2 billion. So that's an increase of around 9% year over year, which is an even faster increase than their top line revenues. So right here we can see their balance sheet comparing June 30th, 2022 to March 31st, 2023. During that time period, total assets increased from $364 billion to $380 billion. And their business is pretty much financed right down the middle between liabilities and equity. They have $185 billion of liabilities and $194 billion of total stockholders' equity, with their retained earnings increasing from $84 billion to $108 billion during this time period over the last 3 quarters or so. So that obviously gives them a lot more cash to redistribute to shareholders through share buybacks and dividends, and then to also reinvest back into their company. Microsoft is one of the few big tech companies that actually does pay a dividend to their shareholders. And so right here, lastly, on their cash flow statement, we can see their operating cash flow shows a decrease from $25 billion to $24 billion year over year. And in their financing activities, we can see they repurchased around $5.5 billion of common stock, which is down from $8.8 billion in the prior period. And they also paid out around $5 billion of cash dividends, which is up from $4.6 billion in the prior period. So they're still prioritizing returning value back to shareholders. The 5.5 plus the $5 billion of dividends adds up to almost half of their operating cash flow. So that's definitely a pretty big investment in returning value back to shareholders for Microsoft. Now we have this discounted cash flow model to figure out the intrinsic value per share for Microsoft. Yahoo Finance is estimating that the company is going to grow at around 12% for the next 5 years. They had $65 billion of free cash flow in 2021, $25 billion of cash on their balance sheet after subtracting debt, and $7 billion of shares outstanding, which puts their intrinsic value per share at $156 per share, which means that compared to their current share price of $308 per share, they're currently not trading below intrinsic value per share based on these estimates from Yahoo Finance. And then on the right-hand side here, I compared them to some of their competitors, the other big tech companies, Apple, Google, Amazon, and Meta. We can see that across the board, it looks like Meta has the highest gross profit margin at 79%, but Microsoft comes in second place at 68%. Microsoft has the highest net profit margin at 36%, but as the article pointed out, if they're able to successfully integrate artificial intelligence into their search engine products and then also increase their cloud revenue and their cloud net income, then their net profit margins could increase even more than this. Return on assets comes into about 20%, with Apple coming in first place at 28%. They have the highest PE ratio at 33 times earnings compared to their competitors, which are more in the 20 times earnings range. And then they also pay out the highest dividend per share at $2.48 per share compared to Apple's 90 cents per share, and the other 3 big tech companies don't pay a dividend to their shareholders at all. So in terms of comparing them to the other big tech companies in their industry, it looks like Microsoft is very competitive from a profit margin standpoint. They obviously have the largest line item for their bottom line net income, and they are paying the highest dividend out of any of their competitors. And then to end the video off, I wanted to compare them to some of the other companies we've looked at in the past. Microsoft at the moment is trading at 197% their intrinsic value per share of $156 per share. They're trading at $308 per share, so they're trading at a little under 2 times their intrinsic value per share, which was good enough to get them into the 10th place spot on our board here. Google, ConocoPhillips, GE, and ExxonMobil are still the only companies on our list that were trading below their intrinsic value per share. Then on the right, we can see in terms of growth rate, Microsoft has a projected 12.54% growth rate for the next 5 years. So that puts them in the 10th place spot on our growth rate table here. In terms of profit margins, we can see Microsoft has a gross profitability ratio of 68% and a net profitability ratio of 36%. The net profitability ratio puts them at the top. They've been at the top of the net profitability list for like the past 30 videos now. Nobody's been able to knock them off the top of that list. And obviously, as the article pointed out, If they increase the price of their products and continue to invest in research and development, their profitability could increase even more than this. And then lastly, we can end the video off by looking at their stock performance over the last 5 years compared to the other companies we've looked at. Tesla holds the number one spot at 781%, but Microsoft over the last 5 years has returned 215%. They've obviously had this little run up since the start of 2023, and that's obviously contributed to their 5-year performance. And so they come in the 6th place spot on our list of the top 10 stock performing companies that we've looked at so far over the last 20 to 30 companies we've looked at. And so based on these tables, it looks like Microsoft is very competitive, and we can also see from the industry analysis that they're very competitive with the other big tech companies. So across the board, Microsoft is definitely a company to watch out for from a financial ratio perspective. But lastly, from this discounted cash flow model, we were able to figure out that based on these projected growth rates with this discount rate and terminal value and some of the other metrics currently sitting on their financial statements, that they are not currently trading below their estimated intrinsic value per share. So let me know in the comment section down below what you guys think of Microsoft. Is this a good buy in the market right now? Let me know your thoughts in the comments down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.